Hello, everyone, and welcome to Investing with IBD podcast, sponsored by North Coast Asset Management. It's Justin Nielsen here, your host, and joining me, as always, is Arusha Pires. He is the O'Neill Global Advisors, one of the O'Neill Global Advisors portfolio managers. It's September 7th, 2022, and football season is starting. How are you doing, Arusha?
Hey, I'm doing well, Justin. Yeah, it's pretty crazy that the NFL season's about to start. I guess when everyone's listening to this in
Yeah,
another
when this
hour or so, a
drops.
few hours, right? Yeah.
Right. hmm and of course, college games have started. I noticed that you still, for some reason, have your USC helmet in the background because, you know, I don't know. I don't know why. Doesn't make sense to me. But
Well,
both UCLA and USC won this weekend, so
which is cute, and I mean it's been a long like 10 plus years for USC, and so it looks like they actually might finally be starting to get good again. Justin, I hope you enjoyed your break there.
in addition to Arusha as our special guest, we have an even more specialer guest. That's Jared Tendler. He is a mental game coach and author of The Mental Game of Trading, which I just so happen to have a copy here. My copy is signed, so that's not something that everyone's going to have. So
Can't be
thank you for that,
official.
Jared. It's The Mental Game of Trading, and the subtitle is A System for Solving Problems with Greed, Fear, Anger, Confidence, and Discipline. Welcome back to the show, Jared.
Thanks, guys. It's good to see you both. I miss you.
Well,
Well, you're
it's
in the
good to
right
see
place
you.
for anger. People who are angry and confused. So
Yeah, well, and yeah, help build up Arusha's confidence again, and maybe introduce some discipline here.
I
And Jared, man, we got to just address right off the bat. It's a very different market from when you were on last. Last time we had you on was in January of 2022. Of course, you recently made your debut on IBD Live, and what a day that was to have you on because we had Jackson Hole going on in the background, and talking about discipline and cutting through the noise and everything like that. So it's really going to be interesting to have this talk with you in a very different market environment. But maybe you can start out by kind of addressing some of the things that we were talking about on that Jackson Hole day when you have this big news event out there that's kind of turning the markets to and fro. And what is a trader to do to kind of keep their hands steady on the wheel?
Yeah, I mean, I think anytime you're in volatile markets, right, the thing that keeps you steady, like a ship out to sea in stormy weather is the stability of the ship itself, right? And as traders, right, you need to have a system that you know well and can rely on and know makes money. And so if you get caught up and kind of swept up in that volatility, it's going to happen for predictable reasons. And sometimes that reason is simply you actually don't know your strategy, your system as well as you should. And that's might sound kind of silly on the surface. Like, how could you not know? But 30-second elevator pitch,
Right.
could you actually very cleanly articulate what your strategy is under extreme pressure? And I think a lot of people watching this, the answer is no. And it's at least 80%, but 80% ain't good enough on days like that, or in general in volatile times. Like, it needs to be stone cold 100%. And that alone will take away some of the emotional volatility. And if it doesn't, the good thing then is that it's going to make it more clear where that line is between, kind of the mental game and kind of more of what the book is really all about is, identifying where those emotional biases comes in, right? Where the greed, the FOMO, the anger, right? Where you're kind of imprinting bias and illusion and wish and hope and your goals, your confidence kind of into the market, and being able to draw that line gets a lot easier when you've cleanly articulated your strategy.
yeah, well, it almost seems like part of your strategy is to avoid events as emotional as potentially what the Fed is going to say or what Chairman Powell is going to say, and putting all your hopes on that on an event, whether they're going to lighten up or maybe they're going to end the raising, or they're going to be a little bit more
Mhm.
dovish, or what word are they going to use? Have you coached traders that that's part of their strategy, where it is betting on some kind of larger instantaneous macro event or analysis of that, or
Yeah,
at least a
absolutely.
Fed kind of thing?
Absolutely, man. I think the difference between the people that I've coached that have done this and the ones who may have gotten caught up in this are that I would actually call them traders versus gamblers.
Okay.
And that distinction needs to be made, because gambling is trading or betting on an edge that you haven't defined cleanly or is actually proven to be losing in the long run. That's why, Vegas exists, right? Because Vegas has defined the edge. So you have to define your edge. And so the traders that I work with, by and large, right, they understand, the massive opportunities that come on moves like that. And oftentimes they're not always, kind of betting in advance, but they are very quick to, what I'd say is kind of like fly without navigation. I mean, this is not something that traders, I think in general with less than 3 years of experience are really capable of doing, though they probably wouldn't admit that that was the case, right? It's really, traders have seen a lot more and can understand how to kind of navigate without kind of a pure indicator saying, yes, they sort of have seen patterns and they can sense opportunity very quickly. And then they also have the ability to very quickly get out when they're wrong. I mean, that is just so important on volatile days. It's fine to make, we can all make bets, right? And we can still define it, but where it becomes gambling obviously is when you start trying to double down on that initial conviction, and then things can really get deeply read quickly, especially when we were talking last week.
Yeah, well, especially if you're doubling down on losing positions, right? And that's, I feel like one of the things that is a trap for a lot of beginning investors is that kind of resistance to being wrong, where they're like, no, I can't, I don't want to be wrong, and if I just keep on buying, maybe eventually I'll be proven right. So there is that element of, I guess, discipline and accepting losses. Is that something that you find is hard for some of your clients?
Well, yeah, I mean, I think we have to clarify, right? Is it discipline? I think on the surface, that's what most traders end up thinking that it is. It's like, oh, I'm getting undisciplined in this spot. I think it's, in that example, it's really much more about confidence. You're okay. So you're averaging down or you're doubling down, right? You're doing a martingaling strategy in the markets, like,
Right.
But what are you actually betting on, right? You're betting on that initial conviction. And why would you do that? You would do that, say, primarily, not always, but primarily because you can't be wrong. Like, what would it mean for you to be wrong? Like, you're going to lose conviction. It's not about the money as much as it is how much being wrong is going to cost you confidence. And then that confidence then can lead to other problems downstream too, right? Then you're going to do even bigger things to try to regain it. So I think on the surface, right, these violations of our rules can be kind of deemed as a discipline problem. And not on the surface as a headline that, makes sense. But when we start to dig beneath the surface, and the way that I outline in the book, we talk about greed and fear and anger and confidence issues before we get to discipline, because we have to rule those things out as the primary driver of that violation of the rules, right? Jumping in too early, right? Reacting to FOMO, right? Okay, obviously market's ripping up, right? We thought it was going to be, negative based on those comments, and all of a sudden it just shoots up. Now, are you going to jump in violation of your rules without a proper entry signal? And if the answer is yes, well, what is it, right? Pure FOMO is, I believe that I'm never going to get another opportunity. Now, that's obviously a delusion. You're of course going to have many, many opportunities, but in that moment, that's what feels real. So it's not a discipline problem. It's an emotion, right? You're getting swept up in, the volatility internally as much as it is, reflected in the price action.
Have you run across clients that, because for the most part, with IBD and kind of the rules that Bill O'Neill taught all of us years ago is, write down your rules, try to remove as much emotion from your trading plan and from your trading decisions as possible. Do you run across clients who, maybe that emotion is their advantage? Maybe that gut feel helps them, and they've actually incorporated it into their trading plan.
I mean, I think when you've reached that pinnacle, you are, a very, very savvy trader, and one that has a very good understanding both of your system and, of course, then, your emotions, right? So yeah, like if we're viewing emotions really as a signal, either as internal flaws and biases that are reacting to, price action, right? They're coming internally, or their emotions reacting to weakness in your strategy. But if those things are pretty well taken care of, or you're in a spot where you're just more in tune with the market, just trading very well, the emotions that you feel really can become that, kind of indicator of intuition and that next level sense, being in the zone, right? And it can be fear-based too, right? You can sense that your positions might be a little bit overexposed, might be time to trim here, or even liquidate entirely. So yeah, but to get to that point, you've got to very cleanly distinguish the fear that is reflective or the excitement that is reflective of legitimate opportunities, right? We're not going to say guarantees, but legitimate opportunities versus the fear, the excitement that is going to be more indicative of the internal flaws or the weaknesses in strategy. And that just takes some research internally, doing what I call mapping, right? Second chapter of the book is really designed to help you kind of map those patterns. So if we can kind of hold up on one end, this is what legitimate intuition looks like. Here are all the criteria and characteristics. Here's what the BS emotion masquerading as intuition looks like. And, create that differential. It's a very simple task on the surface. It just takes the work and the ability to kind of be curious in moments when you have that kind of pure, intuitive sense versus the emotional one, and then tracking the emotional one. But, like anything else, right? You're good at understanding patterns in the market. So why would you not do the same thing with yourself?
Mm-hmm. Well, and I want to kind of jump back a little bit because you mentioned that it maybe takes like 3 years for you to get some of this down, and I mean that process of mapping, you almost have to be in uh, long enough to kind of experience some different cycles, because certainly for a lot of people that started in 2020, they might have gotten a skewed example of what the stock market is like. Oh, you just pick stocks and they go up, and they go up a lot, as opposed to what the market is right now, where you've seen a lot of those same stocks that have gone down 70, 80, 90% or more, and that was just unfathomable to a lot of people when you had these fabulous stories, these stocks that looked like they could do no wrong, where the phrase "to the moon" was used all the time for almost everything. So how so this mapping part, is this a part that is best done in bad times, after bad times, or while times are good before they get bad, or is it just a process throughout the whole journey?
Yeah, I think it's a process throughout. I mean, I think if you're savvy enough to recognize that you've been, kind of isolated, and it could be you're a trader getting started in a bad market. I mean,
Hmm.
I've worked with traders that have gotten started in 2007, right? And
Right.
you know, Lord have mercy on their soul, and it was incredibly painful to work through. But a lot of times, right, those types of traders come out really, really hardy, kind of like companies that survive deep recessions, right? There's a degree of resiliency that's kind of baked in, that they kind of come out with. But the mapping process is really, I think, important at all times, mostly because it kind of weaponizes your awareness. So yeah, if you are savvy enough to recognize that you've been isolated, then when things pivot, right, you're not going to be kind of on your back foot. You can kind of be more proactive. And I think in general, this is not just an issue that traders experience. In general, people are just much more reactive rather than actually being proactive and thoughtful about the kind of the potential problems on the horizon, right? I mean, the tea leaves have been here for quite a long time. I mean, maybe there was a bit of a top signal when I released the book in the crypto market, because it literally was the exact top of the market last year. But
When is your next book coming out, Jared? That's what we need to know.
4 years. No,
Okay.
there's time. But being able to kind of figure out, right, not just reacting to price action in the short term, meaning that, right, the emotions that are reacting to those, I think is just an important process to be thoughtful, right? What are the potential problems that are on the horizon always? And then your emotionality is a key one that can pivot, right? Overconfidence, probably one of the most common problems that nobody talks about.
Mhm.
Yeah, you mentioned something about 2007. Now I remember, I can't remember exactly what the study was, but it was saying something about where you started in an investing cycle, where you really started to invest, and those who were investing like in a those first 5 to 10 years, if it wasn't a great bull market, for the rest of their kind of investing career, the next 30, 40 years, they were always optimistic versus the ones who their initial experiences were like maybe a 2000 or a 2008. They were always much more risk averse, or they respected risk a lot more. And I definitely can talk from my own experience. 2000, and I know Justin, the same thing, is 2000 was early on in our kind of investing careers. And that continues to, that left that imprint where that's always in the back of our mind. So in 2008, we were kind of ready for it. And, after 2020 and 2021, and especially this year, these type of environments don't surprise us because that initial kind of experience has been imprinted. Your thoughts on that? Have you run across clients like that? And, is it best to try to work to change that, or, use that to your advantage?
I mean, I think at the end of the day, we're looking for your fingerprint, right? And like, what is like the essence of this sort of combination of your personality, your values, your ethics, your interests, right? Because that's to me the coolest thing about trading, which is a lot like poker too, where there's so many different games, there's so much variety out there, and so many different styles and ways that you can trade and markets that you can trade in. So to kind of figure out like what is your exact fingerprint, how you sort of see things, I think is an important process. And so, yes, I do think there will be some people who can be a bit too skewed and overreactive and over kind of pessimistic and overly risk averse, and then conversely the opposite side too. And so what are we trying to look for? I think it's if you deem it to be a problem, then it's a problem. If you don't deem it to be a problem, I don't think there's anybody, including myself, who could say otherwise. And that's really not like a part of my work. I mean, I think I come and work with people who have raised their hand and said, I want to get better at these things. Mm-hmm. So you kind of have to recognize, all right, take a step backwards. All right, is my pessimism hurting me? Hurts me here, but helps me here. So what's the relative, advantage, disadvantage? How does that kind of even out? And my guess is it's probably to your advantage, right? But maybe there are a couple particular types of setups or a couple, versions of market conditions where you're a little slow to get in and slow to maybe kind of see that pivot and that, that kind of turn in the market. And so then it's kind of hurting you where you're maybe not necessarily pessimistic. That's hurting you. It's sort of the malaise of just being in a bear market where things aren't really moving and, kind of getting like fatigue, right? I think it's hard when, day after day, you're not seeing opportunity and you're sitting in cash or you're sitting with only a couple positions and, just kind of waiting. And the way that I kind of pitch this to, clients, like you got to be like the backup quarterback, right? Just at a moment's notice, you have to be ready to get in and help your team win. It's hard, right? 14 games in the season, you haven't played a single, play. Like to be ready to go on the next play is hard, but I think that's the challenge. And so sometimes that means actually spending less time in front of the charts so that there is, in my mind, no time that you're in front of the charts where you're bored, right? Mm-hmm. That boredom becomes a signal to just get the hell out, right? You want to be there sharp and ready because you don't know when it could turn. And if you're not there, right, with the right mentality, then you could be kind of on your back foot, and then the pessimism could kind of create a bit more resistance to getting in than would be ideal.
Mm-hmm. Well, since you brought up the sports analogy with football, when we come back, we'll get a little bit more into some sports analogies and more importantly, how you survive the game and increase your longevity so that you can really get those big returns. Stay tuned. We'll be right back.
To help alleviate some of the pain that comes from bear markets, we recommend investing 20 to 25% of the equity portion of your portfolio in a tactical strategy. If you're especially risk-averse, we recommend a higher percentage. In 2008, the market declined 37%, yet our portfolio was only down 12%. Why? Because the conditions for investing were poor, so we held a lot of cash. Visit northcoastam.com/tactical.
Okay, welcome back to the Investing with IBD podcast, sponsored by North Coast Asset Management. It's Justin Nielsen here, along with my weekly guest, Arusha Pires, portfolio manager at O'Neill Global Advisors. And our special guest this week is Jared Tendler, returning back to the show. He is a mental game coach and author of The Mental Game of Trading. You can follow him at Jared Tendler on Twitter. Jared, you were kind of talking before the break about this whole concept of, hey, you know what? There's sometimes where there's not going to be the money pouring in. Heck, you might even lose some money, give some money back. And on IBD Live, you kind of used a slot machine analogy. So I know we keep on going back to gambling here, and you do have your poker book as well. So kind of explain a little bit about that mentality of, I guess, taking that big picture, like if you're in this for the long haul, how a slot machine, acting like a slot machine might be in your best interest.
Yeah, I think the big picture here, right, is that you have to be the house, right? The house is the one that is setting the edge in this game. And we know, because of the size and scale of the Vegas hotels, how well they have rigged the game. And they rig it because people want to be entertained and they want to be seduced into thinking that they can have these big wins and win the lottery, right? But what happens to people that win the lottery? It's actually, sadly enough, what happens to like 60 to 80% of retired NFL and NBA athletes.
Right.
They go broke within 3 to 5 years, which is awful in its own right. But it comes down to not really having the skill to be able to manage money, yada, yada, yada. But the point is, right, you don't want to be in that category. You don't want to be in the markets like looking for these big wins as a way of making money long term. That's actually not really kind of the full picture, right? You want to be developing an edge in the market that is reliable and one that does not care about the ups and downs, either in price action or in P&L, right? If you make $10,000 today, you did not earn 10 grand, just like a casino that took in $10,000 or so, let's say paid out $10,000 in winnings in, on their slot machine floor. They didn't lose 10 grand. They made their 8%, right? And so if you made 10 grand today, what was actually the amount that you earned? It's not 10 grand. So what we can do is start to kind of normalize, the extremes of what is happening kind of in your daily P&L to something that is more appropriate to your edge. And what that does is it actually helps you to become a bit more driven to be a well-functioning slot machine. Because what happens on casino floors, slot machine's broken, that thing is not getting turned back on until it's fixed. The casino is not going to take the risk of something really bad happening. But what do many traders do? They are actually gambling because they don't have kind of the internal mechanism for themselves to take themselves off the floor. Right? You need to be able to have that ability to kind of be your own coach in a sense. So defining that edge, leveraging that edge is a function of how well you can understand how to create it on a reliable basis. And then when it's not your day, which is going to happen, it's not your market, which is going to happen. It's not just pull yourself off the floor, pull yourself off the desk, because it's gambling at that point.
Yeah, well, and going back to what you were talking about with the $10,000 analogy about like the outliers, right? Doesn't really matter if it's in the stock market or if you're at the casino or if you're playing the sports. If you have some kind of unusual event, you need to recognize that, right? And put that into your strategy to realize that this is not kind of a normal recurring type of event here. If this is kind of an outlier and more to a positive side in this case, you got to take some money off the table, lock in some of those gains, or know where how to kind of manage that and not expect that to happen all the time, right?
Absolutely. Yeah, I mean, I was saying 10K even as like something that would be normal, right? I mean, I realize it's not normal for everybody that's listening, but the ability to, I mean, listen, when people have large outside events, my advice always, even if you make, a good amount of money, is to take at least one day off, right? To absorb it, right? I mean, when I've had either traders or poker players that have had some significantly big outlier events, right? They win a big poker tournament. They have, the best month ever by, some factor. You're not allowed to spend that money for some period of time. It's not yours, right? It's locked away. I'm not saying that you can't, put it into a, short-term savings account, right? Something that, but the point is, you're not treating it as it's yours until you are able to kind of absorb the significance of it, right? What does it actually mean, right? Is it truly an outlier, or no, actually it's reflective that my capacity here has really leveled up, and I can, kind of treat this as a bit more normal, or no, it was true outlier. So then I'm actually taking a large chunk and putting it away, and only taking a small chunk and putting it into my account balance, right?
Mm-hmm.
And then making that, a bit more normalized that way.
Mm-hmm. Well, let's talk a little bit maybe about that concept of getting better, and I think that's what a lot of us strive to do. Even, I mean, I got to tell you, when I was watching Bill O'Neill and the portfolio managers in that 2000 market, and luckily I got to participate a little bit on the upside before things all went to hell in a handbasket. But the big thing was that they had made so much money in that run up, and they kept a lot of it, which was amazing. A lot of them were selling into these climax tops, but Bill insisted that they do a post analysis still to kind of say, hey, what could you have done better? And again, it's not to say that you didn't do a great job, guys. I think they had like a 1,400% return from like 98 to 2000 to 2003 or something. So they retained a whole bunch of it. So it kind of reminds me of this inchworm concept that you wrote in your book about how you want to kind of get to a point where you're increasing not only the gains that are potential for you, but what a lot of people don't recognize is, hey, also kind of getting those bad trades off. Can you kind of flesh out that inchworm concept of yours?
Yeah, I'm glad you brought that up, because I think it's one of those concepts that both readers of the poker book and the trading book really it stands out to them, mostly because it's a little bit noteworthy. And for those that don't know about it, he is actually saying inchworm, like an actual caterpillar that looks like a worm.
That's not a pattern. That's not a new chart pattern.
And it might be a little squirrely for some of you who are like, how did we get to talking about insects?
Right.
But
I just went to the zoo. It's just a follow up to that.
Exactly. And of course, you're going to see an inchworm at a zoo, right? This little guy is going to get eaten by every insect eating animal there. So the inchworm, as you sort of see it moving here, in my mind, kind of describes perfectly what improvement looks like over time. And you see sort of this pattern where the back end is kind of anchored, and it allows the front end to kind of stretch forward, and then it anchors and then kind of inches forward from the back end. Now, if we look at this as like the front end is your A game, the middle is your B game, the back is your C game, right? You at your worst, or your worst trading decisions, not necessarily your worst outcomes, right? We're going to be more kind of qualitative, skill-based oriented here, process oriented. So C game is your worst performance. If that does not get better, right, you end up in a scenario where that front end actually is going to be limited. Your upside gets capped. And so it's so easy for traders, for poker players, for professionals to want to, kind of focus on their strengths, to focus on the good parts of their skill set, but the descriptions you're describing about, processes that Bill had put in place to really unearth and expose the ways in which we could be better is really essential to moving that back end forward. Because when you do that, you then create the conditions for that front end to take another step forward from the front. And, especially for the perfectionists out there, those with high expectations, I'm sure nobody in this room is of that category. But it's so easy to kind of think that your current version of perfection is like the limit to what you can do. And it's not. That's the cool thing about this inchworm concept as well. It shows you that perfection is a moving target as well, right? As long as you continue to progress, your definition of what is perfect progresses. So in my mind, perfection right now is defined by your inchworm, right? The very front end of your, performance is your version of perfection today. But as soon as you hit it, you've created the potential for it to grow. And the question becomes, how do you do that? Well, it's very easy, especially when, again, you're in sync with the market, you're doing really well, making a lot of money, making a lot of really great decisions, to think that it's just going to continue, or to actually kind of press it and force it to happen more. When in actuality, if you become aware of all that, the best thing you can do is focus on your B and C game, because improving in those areas is what's going to create the opportunity for you to move that front end forward again. Because when you're in your A game and you're in a really great state, there's actually a lot of content and knowledge that's in your mind that hasn't really been owned yet. It hasn't been consolidated. It's not like the back of your hand, like an instinctive part of your skill set. You need to kind of move it through the learning process to get to that back end, for it to kind of truly allow your mind to be freed up so you can learn new things, right? We have a limit to how much we can learn at one time. And, you want to take things off the table by consolidating it, by mastering it, rather than just filling your mind with all this new stuff and thinking that somehow it's going to click. Or you can't, listen, there's a lot of people that procrastinate and cram for tests and think that they can get away with it. And they probably did in school. Mm-hmm. Trading is not like that, right? You cannot procrastinate or cram for the market, right? Every day is a test. How well have you prepared for it, right? That it's ultimately kind of going to give you that feedback on how well you're doing. And a lot of times it's going to expose some pretty big gaps in your preparation. So interim is a way of kind of reorienting your mind around how to get better, how to prepare, because some days you're not going to have it. And so, the operative word there is suck less, right? How much can you suck less on those days? Right. I mean, it's a simple idea, but one that, can really pay dividends, especially for those that, can kind of give up. Like you're 70% of your way to your daily loss limit. You're like, F it, and just, throw it in. It's like, no. If you want to get better at this consistently, you have to make the hard decisions, even when every part of your body is screaming, F it, just throw in the extra 30%. If you can pull yourself away, right, stop the bleeding, you've sucked less. Cool. Now you've got 30% more that you can use tomorrow when maybe you're going to be in a better spot.
And I just want to real quickly address that concept, because for those that are watching the video at investors.com/podcast, you might have noticed that Arusha did a little bit of a wardrobe change. It wasn't a wardrobe malfunction, and so Arusha, do you want to say anything about sucking less? Because you've got some football teams where, you kind of know about sticking with them through the tough times, right?
Yeah. Kind of like you've known with UCLA football for quite a while, but well, I mean, really getting to the I think that's a nice transition, not Justin's transition, but the Inchworm's transition of going to the game.
You're not going to give me compliments.
Exactly. Essentially going to the game of inches, right? So the NFL is starting this week, starting tomorrow. We're recording on Wednesday right here. Jared, now let's get into kind of we've gone a little bit into the kind of the sports gambling, or kind of, and there are different categories, right, where you almost have your degenerate gambler, and they were kind of exposed, or they kind of came out in 2020 when all sports ended, and so they had to find other things to bet. And then you have kind of your professional sports bettors who they really study the game, kind of like horse racing or even the stock market or whatever, where it's not necessarily gambling, they're managing their risk. Going into kind of those different categories from the sports side.
Yeah, I mean, it really is the same thing. I mean, sports betting has, I think, an even smaller edge than trading and poker typically does. I mean, I have guys that they are thrilled by having 1.5% kind of on as a return on their capital, which is crazy when you think about it. I mean, I had a guy last year who made $1 million, and I think his edge for the year was like 3.5%. So you think about like how much you had to be wagering throughout the year to make that money is like
amazing. Yeah.
Holy mother of God. And actually, I should say he made $1 million just betting on football. So more than that with baseball and a few others. But yeah, I mean,
but it's a profession to him, right? Clearly it's a profession to him.
And I've got another guy who's down in Australia, they call it punting, right? So he's a horse punter down in Australia. Massive modeling, has a whole team of people around him. It's just wild. I mean, but they take it as seriously as traders do, as well, maybe not poker players, because poker players tend to be a bit more on the degenerate side, but that's anybody who is, I mean, like I've got PGA Tour players I'm working with. I mean, my God, I mean, one guy, he has me, he has a manager, He's got a nutritionist and a trainer and a putting coach and a swing coach and an agent. We get together in a room. It's like, wow, your payroll's deep, but he does not care about money. He cares about winning, and he cares about winning at the highest level. And so every little edge that you can find is essential. So yeah, the real sports bettors, the real traders, the real poker players, the real golfers, we're all doing the exact same thing. It's like finding those edges. And in my mind, right, from a mental standpoint, it's like, that's what I'm weaponized to do also, is like find those little opportunities where, thinking a little bit differently, reacting a little bit differently is going to make a difference in some key moments.
Now, what about 2020, where all of a sudden when all sports ended,
Right.
people were betting on anything they could bet? Talk a little bit about that.
So I had an interesting experience. I mean, for a lot of people, March 2020 was pretty painful. For me, it was like a deluge, like of either new clients or old clients coming out of the woodworks. In poker, there was more opportunities than they could even capture. I mean, obviously it was all online, but these online sites created so many big tournament series, and whenever there's a tournament series, cash games are massive. I mean, burnout just became like the immediate big question mark. How could I capture all this info? And then, of course, some new traders, kind of came into the woodworks, but like we saw the massive influx of new traders in the market. And so in my mind, like I saw poker was where everybody went, or the markets was where everybody went, because there was no sports. And so then the real degenerates went to like marble racing. I mean, they went to like, like a Seinfeldian, Kramer, like betting on which flight was going to, be delayed. I mean, it was whatever they could bet. It had to go somewhere. And then, we get stimulus checks in the US and thrown into the
I've got to do something with this.
Yeah. It's like, it was like burning holes in people's pockets. So yeah, I mean, there's ways of doing it right, and there's ways of just doing it. And there was a lot of people who were throwing money around in a lot of different places.
Well, and it kind of goes to what you were talking about before about people who don't know how to handle money, right? All of a sudden they had these checks coming in, they didn't know what to do, so they started betting on marbles.
Yeah, or Bitcoin, and whatever they could throw, whatever made sense in the moment. There was no rhyme or reason, no rationale, no strategy, no system. Obviously, how would you have a system? Right. It's like, so yeah, I mean, and when I say the degenerates, gamblers, like they're all walks of life. I mean, I said, I know many people who I will remain nameless, who are very successful in business and will throw money around in lots of places, right? Who are the private game, the poker players playing private games against? They're the millionaires and billionaires, and they don't care about the money, but yet they want the action, they want the challenge. And so, yeah, when everything shuts down, money's going somewhere, and people are going to create excitement. And that's not a bad thing. I'm not going to say it shouldn't exist, or, we should kind of be limiting people's ability to have fun. The question is like what you want, right? And if you want to make money, then, having fun shouldn't be at the top of the list of what you're trying to do.
Mm-hmm. So now to kind of wrap this all up, and again, kind of getting back to this whole concept of, surviving, because that is a huge part of it. I mean, just being able to survive long enough is the way that, some people have built their fortunes, right? They've just been at it for long enough. They've gotten better. They've maybe had some good runs that have really kind of had those life-changing moments. They haven't completely squandered things when they've had a couple things go against them. They've had their risk management in place. So again, this is a very different market from when you were on last in January of this year. It's come down considerably. There was already some of the stocks that were down considerably, went down even further. So now that people have kind of been introduced to this side of the market, what's the next step for people that are making that decision? Maybe they started in 2020, but they've made the decision, no, I want to stick with this. I want to continue to do this, and I want to get better. What's kind of like the overarching best way to do it?
I mean, I think Inchworm kind of helps us out here, right? So the people that you were talking about really sucked less a lot throughout their career, right? That survival is really that their back end level of decisions never took them out of the game. It allowed them to continue to survive and ultimately then thrive when, the getting was good. So I think for the people that have started early, 2020, and are now trying to pivot, if there was some significant pain points, maybe not in that year, but in 2021 or even, in parts of this year, it can be easy to kind of let those failures and let those losses really loom and kind of create like a dark cloud hanging over you. But what they're going to do is they're going to kind of anchor the back end of that inchworm where it is. It's going to literally hold you back from progressing, right? There's a difference between, learning from your failures and having them ultimately pay you back. There's a client I talked about in the book who, I forget the exact number, but it was definitely like north of a couple $100,000 that he sold a position that he had a very big conviction on. And it ended up, he made some money, but he didn't make the life-changing money that really he could have at that point. Fast forward to 3 or 4 years, we kind of worked through that because that was kind of part of what, he was kind of coming to me to work on was the regret and the pain from that. At the end of our kind of work, he got to the point where he was like, I would pay $200,000 to have that experience and the knowledge that I've gained since, right? Somebody who was willing to kind of do the work for that 4 years period to like actually get good at this. So look, it's a hard choice to make. We're going to talk a bit more about the NFL here, but so many traders think that they can just plop down, money in an account and think that they can play in the NFL. That's the equivalent of what's happening.
Right.
And so, yeah, if you do that, you're going to get blown up a few times. You're going to have your handed to you a few times. It's going to be really painful. The question is, do you take those pain points as points of learning, points of growth, points of opportunity, or do they like kind of really, stick with you? And I think to kind of massage through that scar tissue, it requires just actually like looking at those failures, looking at like, why am I still holding on to this? What did I learn from it? How can it turn into something of value? If you can do that, right, you have an opportunity to actually kind of free that scar tissue and allow that inchworm to kind of start moving again. And then you're going to be better for it, right? I mean, that's what, you guys have talked about, right? Been in this game for a long time. You've seen all the different ups and downs. And as a result of that, you're knowledgeable and not emotionally attached. And that's a big key to being successful long-term. So if you're going to make the choice to keep going in this game, it's not about like forgetting the past. It's really about learning from it and freeing your emotions up from it. Because otherwise you're just going to get stuck and then, you're kind of damned to repeat it.
Yeah. I mean,
well, we often talk about that as the tuition, right? the tuition of Wall Street, right? Where you make those mistakes, and if you can learn from it, it's tuition that becomes well worth it. I'm sorry, go ahead, Arusha.
No, and I mean, there are so many parallels with the way we invest there with the inchworm, where you're incrementally moving in to the market, you incrementally move out, you incrementally build into larger positions, and all of a sudden the market starts working, and you have some decent positions. It's not like you just jump in with a large position. So you're slowly inching in, and the same way you're with your larger with your portfolio, your equity curve. The goal is to just slowly grow it, to incrementally increase it, and inch it higher, and not get too much back when you're out of sync. So there's so many parallels with the inchworm there.
Mm-hmm. Well, Jared, got to thank you once again for coming on the show. It was really great having you. It was great having you on IBD Live. So for people that haven't checked out that video, it's something that we have out there on our video list. If you can just go to investors.com/video, you'll probably see it up there if you check that out. And of course, the video here will be available. If you want to see that inchworm in action, you can see it in action while he was talking about it at investors.com/podcast. So thanks again, Jared, for being here.
Thanks, guys. It was a pleasure talking to you as always. And go Raiders.
Okay, he says with a question
mark.
Maybe we'll have to talk about confidence and conviction a little bit more.
Yeah, we might have to work with Jared on that one.
Jared. Okay, when we come back, we'll talk a little bit about the markets that we're in right now and some stocks that are on the radar. Stay tuned. We'll be right back.
To help alleviate some of the pain that comes from bear markets, we recommend investing 20 to 25% of the equity portion of your portfolio in a tactical strategy. If you're especially risk-averse, we recommend a higher percentage. In 2008, the market declined 37%, Yet our portfolio was only down 12%. Why? Because the conditions for investing were poor, so we held a lot of cash. Visit northcoastam.com/tactical.
Okay, welcome back to the Investing with IBD podcast, sponsored by North Coast Asset Management. It's Justin Nielsen here, along with my weekly guest, Arusha Peiris, who is still wearing a Raider shirt because he just can never learn. But anyway, let's talk a little bit about the markets and go through a few stocks. I mean, today, very strong bounce. Now, it's hard to get too excited here because we had like 7 days down in a row. Certainly it was getting to a point where a bounce was expected. Um, we were kind of using the low of July 26th, where it kind of almost came to the 50-day moving average line after it first went above it, and it came down to that level. We've kind of been looking at that as our next line in the sand, and we got support from that area for the last couple days, and a strong bounce today. What are your thoughts here, Arusha, on where we're at in the market?
Yeah. You could it could go both ways. You could say you're under pressure. You could even argue that you're in a correction. But you're at that key support right now, kind of like what you're
Right.
saying at the low of July 26th, and right below it, there's kind of that lower trading range there that should provide some support where the lows from June occurred. So you're in this really kind of cautious type of area where if you were slowly building up positions in at end of July and August, you've been probably forced more to reduce, right?
Mm-hmm.
If you are following some risk management rules, and so having some exposure makes sense. If you're seeing some, and we'll go over some of these examples here, or some areas that did well today, but it's not a time to be aggressive. So if you're looking at it from a correction, right, or even a say under pressure correction, you want to try to be a little bit more cautious and say, you know what, let's wait for another follow through day type of action. You're still a little ways away from that. If you're going kind of from resetting the account and you're under pressure, this would just be day number one, right?
Right.
If you want to be a little bit more conservative and take it that kind of approach and say, I think we're in a correction, I want another follow through day, this just would be day number one. And so the earliest would be next Tuesday, or sometime next week, where you could get that day number 4, right, on heavier volume. Today's strong day, up 2%. Lower volume than the day before, it looks like. And the one thing that always kind of goes in my head, because it was up 2%, pretty powerful day, but the one thing that has been going through my head, and I think I've been saying it on the podcast a few times here throughout this year, the biggest days come in bear markets, right?
Absolutely.
So every time I kind of see these really strong days and there's not tons of broad market participation, that's the first thing that kind of just rings in my head, that we still could be in a bear market if you're just having these kind of really one day powerful kind of rallies.
Mm-hmm. And that's not to say that we didn't have a very powerful rally from those June lows to that peak on August 16th. I mean, certainly that was something that you could have participated in, but
Sure.
I think it's very very clear that you didn't want to use the same rules that you use in an uptrend. This was still where we were below the 200-day moving average line. We were, still kind of struggling to get out of this downtrend. And the fact that we got right up to that 200-day line on the S&P 500, didn't quite get there on the NASDAQ, just breached it for a couple days on the Russell 2000 and the Dow Jones Industrial Average, but couldn't hold it. I think that just combination kind of says, okay, you're still in a downtrend, and you had to kind of react quickly. And I haven't really been. Normally, I try and use the 50-day moving average line or the 10-week moving average line as kind of a line in the sand, and I just think to myself, if I can hold, through those pullbacks, that's the way I'm going to catch some of these big winners. But in this rally, I was kind of looking at it saying, man, I'm going to use the 10-day or the 21-day moving average line a lot of times, because I just didn't didn't have that conviction quite yet, since we were still below that 200-day line, and because of the way it started with just a paucity of setups. It was the only things that were moving, it seemed like, at first, were those bottom fishing stocks. And I guess my concern now is, well, yes, a lot of things were showing reversals, and that's great and all. There's a lot of places where we could hit our head again. We've got that 50-day moving average line not far away. Then we've got those June highs of 12,320 on the Nasdaq that we were looking at before. And we got above that, but will that provide resistance? At that level, and then let's not forget, you've got the 200-day moving average line still looming. We still have that to breach before we're really going to see the indexes go. So yeah, it's. I think it gets back to that whole incremental thing. Yeah, you can dabble your toe in on some positions here, but you have to be ready to have that scenario in the back of your head that, hey, this might not last for very long. We've seen a lot of sector rotation very quickly. I mean, a lot of the commodity stocks were looking pretty good. The steel, the oils, and the gas, and even the fertilizers seemed like they were setting up again. And then it just seemed like a lot of things were getting knocked down. So I'm not looking for those long positions that I'm going to hold for a long time for those big wins quite yet.
Yeah, well, we're still in this kind of choppy market, right? Where the grind, getting taken to the grinder, where you just people who are really trying to constantly be as aggressive as they were in 2020, they're just going to get worn out, and they're just going to slowly just lose money. So you got to recognize that. Now going back to we in bear markets, you can have very powerful rallies. And once again, the bear market it's just a label at this point. The reality is this is just it's not a great market, so you shouldn't be pushing it, right? But in that previous rally from July through a bunch of August, you had the follow through day, you got above the 50-day moving average. More importantly, I think, especially for our kind of stocks, you got above the 21-day moving average.
Yeah.
And that kind of simple, hey, is it above the 21-day, below the 21-day? That really came from the market school study that you guys did. That using something like that can help save you a lot of pain. I mean, we broke on the Nasdaq, we broke the 21-day. That was the first kind of big sell-off on August 21st, right? So that gap down where you broke it kind of came back above it for a day or two and then sold off again below it. Using something like that will help you kind of lose less, as what Jared was talking about. Right. Now, that being said, it's a tough market. It hasn't made new lows just yet. It may not make new lows. So you still have to keep the open mind to the other side that, hey, we could get another fall through day. We could get above the 21-day, and there could be some setups. And at that point, then you try a little bit again, right? Or you increase your exposure a little bit to see if you start getting some traction. Eventually, this market is going to wear everyone out. That it's going to eventually set up and then start taking off. And if you're not paying attention, if you're not being open-minded, you're going to miss out on that initial rally of the real bull market.
And keep in mind, it just doesn't have to go up in rally mode. It doesn't have to go down in correction mode. There could, as you said, this grind where you're range bound, going back and forth, and especially if the rallies and corrections only last like a couple weeks, it's hard to make progress, and it's very easy to get your timing just slightly off, and then you die that death of 1,000 cuts because you're getting in just as things are maybe breaking out, and then they fail, and then you're taking your losses, and then the cycle just keeps on repeating as you go through that kind of wave from peaks to troughs and so on. So just you have to be careful. And so that's why right now I'm not really looking for the swing for the fences, hitting home runs. I put some positions on today. I'm going to take the profits very quickly if that materializes. If they don't, I'm going to be very quick to get out. I'm not giving these things very much room.
And just very quickly, Justin, the most dangerous market is not the downtrending market, it's the sideways market. right?
Mhm.
Where that
Yeah.
constantly
Sucks you
it can
in.
give you, yeah, it sucks you in. It can give you a number of false signals,
Yeah.
and just it can just wear you down, and you kind of die the death of a thousand cuts.
And especially if you get too aggressive too early, that's where you can really find yourself in trouble. And I've already shared a number of times how that was my biggest issue in 2001 to 2003, was just every follow through day. And there were so many, I was getting way too aggressive way too quickly. And I let's go ahead and just shift a little bit to some of the areas that we're looking strong. One of the things that does concern me is utilities. XLU, if we just pull that up real quick, I mean, you look at this chart, you cover up utilities, and you're like, oh, wow, how can I get a piece of this winner? But are utilities really what's going to lead us out into a strong bull market? That hasn't been the case in the past. I do remember, Arusha, when you and I were sitting next to each other back in 2016 at that early 2016 where we had that correction. 2015 had a lot of volatility, especially
Right.
in the summer. And
Yep.
then we finally were getting some traction at the start of the year in 2016. And man, the IBD 50 was full of utilities, REITs, AT&T, Verizon. I mean, that was where that was where all the action was for a while. It did take a while for growth to come on. So, what's your take on utilities? Is this even worth a shot, or would you rather just keep your money in cash?
I usually just keep my money in cash at that point, or just I'm very lightly invested, and I'm not in utilities, right? I'm not going
Mhm.
to go with where the market is trending at that point, just simply because.
2.6% yield for XLU. I
And you
mean,
know what? And it's a good point. That just because it doesn't work for me, right, or it's not right for me, doesn't necessarily mean that it's not right for someone else, right?
mhm,
If that someone else, if that fits your strategy, and you're like, you know what, let me park some money in the utilities. They're trending well. They're earning that dividend. That's fine, right? Just manage your risk.
mhm.
In the end, you learn those larger concepts of what we're talking about, of the system here, of the CAN-SLIM system, and then adapt it to your own personality and your own situation. That's the most important thing, because that's how you really get better at this. But with utilities, and today when the market kept getting stronger and stronger, yeah, I was just looking at what stocks were working today, and there were a lot of utilities, right?
Mhm.
And so
Yeah.
it was just telling me that, okay, you just be patient, right? Try something if you see something within your kind of strategy, or your kind of the stock framework, where the types of stocks you do well, but you don't have to necessarily push it in something that's you're like, I would get bored. I
Yeah.
mean, we're looking on the chart right here, and the scaling kind of makes it look like this is really an interesting stock
Well, go
from a
ahead and go to the
daily
weekly.
chart. But yeah, but when you switch it to weekly, I mean, it honestly, from a trading kind of, or a price action, it looks pretty good. But when you look at it on a weekly, on a log format here, on a log scale, this thing just goes sideways.
Mm.
It's going to wear me out, right? I'm just going to get so bored of being in something like this, that I already know that I'm better off just being in cash at that point, instead of putting it in a utility.
Yeah, absolutely. And again, there's that kind of preserving your mental capital as well, and not getting kind of, oh, wait, I mean, look, that last correction that we just had, that was 17%. Who cares if you
Yeah.
got a 2.6% dividend if you're down 17% on something, if you bought it wrong? So do keep that in mind. Now, one area that we've been really seeing some strength, and of course, there were some policy decisions here, the Inflation Reduction Act. We talked about that with Andrew Chanin to a certain degree. But let's take a look at Invesco Solar, because TAN, ticker symbol TAN, is showing a lot of strength here. And I mean, certainly if you look at the leaders, whether it be, I mean, Solar Edge, Sunrun, Solar Power, First Solar, Enphase, the whole host of them. There was a lot of action in those stocks today, and that was reflected in a nice bounce that TAN saw on Tuesday, and it just followed up today.
Yeah, incredibly powerful move. This is the number one industry group, the solar group, right? And shouldn't be a shock, because this has been the number one group probably for the last few weeks or so, right? Especially after they went on that big run at the end of July, and after, I guess, with the Inflation Reduction Act. Now, came back in found support off the 50-day moving average. I'm talking about TAN here, and just a really, really powerful move off the moving average. So this continues to act well, and for plenty of people out there, this might be a better option than trying to pick one of the individual solar stocks that move really quickly, right? They might be up 7% one day, down 8% the next day. That's just kind of normal action. So if you can't handle that action and you want a little bit slower mover, you can get in a TAN that's only up 6% today. So the ETF kind of will mute it out a little bit. It might enable you to ride through the volatility a bit better, but overall, this is acting pretty well.
Mm-hmm. Yeah, and let's go ahead and round out the discussion because certainly, as part of that Inflation Reduction Act and some of the climate bill portions of it, there have been a lot of looks towards lithium battery technology, and we've had Pedro Palandrani on before from the Global X team and talked about the ticker symbol LIT, which is their battery technology ETF. This is still below the 200-day moving average line, and it's certainly not just lithium in here. You do have some of those lithium players like the big ones, Albemarle and SQM, LAC and LTHM, but you also have some of those battery technology folks, including Tesla and Boyd. So with something that's still below the 200-day moving average line, still below the 50-day line, is this something that you're even considering, or is it, hey, look, the individual stocks, the leaders in this area just look so much stronger?
Yeah, in this case, I'd probably go more towards the individual stocks. For pretty much any chart, if they're below the 50-day and the 200-day, I'm going to be very, very much more cautious on them. I'll manage the risk tighter, and I generally won't buy anything below that. Now, this is not only below the 50 and the 200. The 50-day moving average is below the 200-day moving average, right? So a lot of times when you see that, when you see a shorter term moving average below a longer term moving average, that means that the trend is still more towards downside, right? There's more momentum towards the downside. So you want the quicker moving averages to start getting above the shorter term, the longer term moving averages. And so it's just going to take a while. So in this case, yeah, I would look for something within the actual battery field or the lithium plays, individual stocks, or look for another ETF that's acting a little bit better because they just might have a better composition of what's working right now in the market versus this, which might be a little bit more broad.
Well, that'll do it for us this week. Thank you so much for helping me out, Arusha, as always, analyzing the market and some of the areas that we're showing strength. Again, I think the takeaway here is, just like the Raiders, it's not necessarily smooth sailing for the market yet, right?
But there's always you always have to be optimistic, and hope that bull market or next playoff run is ahead in the future.
Yes, absolutely. And joining us on the show next week, we're going to have Simon Erickson back on the show. He's from Seven Investing. Really great discussion that we had last time he was on, and we're looking forward to another great discussion with him. So please stay tuned for that when it comes next week. And thank you for watching us this week. We'll see you next time. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.